my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. For quite a while now, prices have been hitting and utilizing the bright red trend line, formed of the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently 845. It seems the market has slowed its decline from the break lower back in October last year out of a bull channel and occasionally staged rallies up to the 50% Fibonacci line of the August 2020 to May 2021 move at 900. These rallies have stalled and the market has expanded the downside, such there is an argument to look at the action since December 2022 as a possible expanding wedge pattern with a flat upper trend line, though I'm not wholly convinced of it, which is why I have not outlined nor marked it on my daily chart, not yet at least. What has been interesting in the increasing declines is that April constructed a monthly key reversal down, and they may very nearly did the same and construct a compound key reversal down, but in the end the market balked at such a pattern and settled for a lesser outside move for May. These moves down and then back up have set up a possible diamond pattern type for the action from April and May. And as we also go into June, I'm really not happy about this pattern type. So whilst I outlined it on my daily chart, I have not highlighted it. However, just in case we have a break higher from this, let's call it a potential pattern. Just in case we have a break higher, then I will outline some levels, if not targets, to look for. Initially, primary level would be in the 902 area, just over the 50% Fibonacci line, with a further harder to reach area up in the 946 level. This brings me to something else that I have noticed and which I have highlighted, and that is the December 2020 to date uptrend, currently at 769 and highlighted in dark blue on my daily chart. This uptrend held up the market in early May and now again this week. Thus, we may be starting to meet a support below that may be as tough as the 50% Fibonacci line is overhead. It is at this time that I'd like to introduce a part of my commentary from 7 weeks ago, and I quote, "I continue to be in a bit of an indecisive move over this market. I can see good supports below and I can see good resistances above, probably reinforced with the declining long moving average, that's currently 874, plus also the 50% Fibonacci line of the August 2020 to May 2021 move further out higher at 900. Overall, much like last week, there seems to be no immediate pattern or path. Perhaps we will just go sideways for a bit with a question mark added on that last statement," and that's the end of the quote. The situation has not really changed much since then, despite some earlier now more current wider ranges. I can see potential patterns, but not just yet. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat here continues to be an easier read with respect to what is going on and what the opportunities might be. In late January this year, prices punched up and out of the upper bear channel line of the first bear channel, constructed between October 2022 and March this year. Then 13 weeks ago, we had the first piece of bearish pressure, coming from how the medium moving average, currently 865, capped the market over the week of the 13th to 17th of February, with subsequent move lower and the following Monday, the 21st. There was some hesitation then, which eventually became a bear flag over the turn of February into March. The market then constructed a second bear channel, which has morphed into a descending, expanding wedge pattern, currently 746 to 883, originating from December last year, but really becoming evident in February this year. This is highlighted in dark blue on my daily chart. The upper trend line, currently at 885, has been reinforced, sort of, by the previously mentioned declining medium moving average, which managed to help cap the market in very early April, then mid-April and mid-May. It was part of the reactionary move down and away from the upper bearish trend line that finally saw the market reach down and achieve the target at 810 for the bearish halfway hesitation from back in February. So looking at this week, it seems for the moment that further attempts on the downside are not being immediately attempted, being held up by the June 2021 low, despite the overall bearish patterns, and the weekly key reversal down 2 weeks ago. We'll have to see how the bear channel come descending expanding wedge pattern develops, and where the market thinks it should fit into this pattern, whether to driven by it or driven out of it. The only other feature is a potential, and just that, a potential double bottom formed since April. It is way early on that as anything more than just an idea. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.